shall I start maybe with a little bit of introduction? So this presentation, I'm going to share this presentation with Aleksandr. Both of us founded Ziffer 10 years ago in Luxembourg. Ziffer Group nowadays combine several business lines. So it combines a family office service boutique called Ziffer LU. Also an early stage VC fund called 2B.lu, and Easy Start, that is a platform providing services to startups in Luxembourg. Our clients are private investors, could be families that would like to preserve and pass on to the next generation its wealth. More risk, investors who are more risk, have more risk appetite, asset managers, entrepreneurs, and also innovative startups, which is really an interesting part. In terms of our VC fund, we invest in innovation. We believe that sharing economy, platform solutions, artificial intelligence and blockchain are our targets where we invest and we know best, and also startups which we work with certainly specialize in these areas. Okay, we certainly, everybody knows that Luxembourg actually is famous by investment funds. It's the largest investment fund jurisdiction in Europe and the second largest in the world after the United States. Recently, the Global Financial Center Index ranked Luxembourg #1 EU financial center, placing us ahead of Frankfurt and Paris. And certainly after Brexit and after London is left the list of the EU, Luxembourg took the floor. There are many structures in Luxembourg that actually facilitate investment activity. There are many regulated funds. Today we are going to speak mostly about unregulated funds. I will explain why. We work with private investors, and they are certainly very cautious about costs that they have to invest into the structure. Our clients mostly, when choosing a structure, they mostly consider cost effectiveness, high reputation among international banks, strong legal protection for investors, and flexibility that allows to implement sophisticated investment strategies. So these are 4 considerations that are very important to our investors. And we believe that the best tool that addresses all these considerations, and especially cost effectiveness, is unregulated investment funds, and we're going to speak about them today. I know there are also questions coming in regarding regulated structures. We do our best to answer those questions, but this is not our specialty. So we will focus on what we know the best. So key factors of unregulated funds in Luxembourg. Unregulated funds are structured mainly as partnerships. So they consist of a general partner. That could be a limited liability company or joint stock company, and partnership underneath the general partner. Partnerships are mainly tax transparent. So investors do not pay taxes in Luxembourg, they pay taxes in the country of their tax residence. And general partner is a company that is resident in Luxembourg. The main difference between partnership that could be used in unregulated funds are simple partnership and special partnership. The main difference between them is the legal entity. Simple partnership does have legal entity and special partnership doesn't. So when to use which partnership actually depends very much on the jurisdiction, on the country where investors are based, because some countries legislation accepts the entities without legal personality and some do not. Okay, so in order to to set up this investment fund, you would need two partners. General partner, which is an investment manager, and investors limited partners. Both could be either individuals or companies. They can reside in Luxembourg or anywhere else. The general partner could also be a limited partner. Limited partner, just a second, may I switch to Aleksandr?
Yes.
To continue the presentation, and I will add something later.
So Maria explained that the general partner and limited partners that constitute the fund. Limited partners are investors to the fund. Typically, these are investment structures of private wealth management, either located in Luxembourg or in other jurisdictions. The general partner is typically an entity located in Luxembourg, which executes the management of the fund and replaces by itself the body which typically in a normal company is the board of directors. The general partner has unlimited liability, hence a typical usage of companies with limited liabilities to shield the people who make decisions on behalf of the fund. In the last couple of years, we see quite a significant increase of interest from the investment professionals from the former Soviet Union, Ukraine, Russia, and other countries to set up this type of vehicles in Luxembourg. What helped is Brexit. This is what you, Adam, discussed a little bit earlier about the impact of the UK leaving the European Union. What also helped is the probably traditional reduction of the activities in the countries, Ukraine and Russia, and moving of the investment professionals to other jurisdictions. But we see quite a few. Typically, these structures are set up by investment managers for the use, we call them club deals, club deal style structures, where investment managers have 10, 15, 20 investors, and then they set up such a fund to invest into a variety of asset classes, starting from alternative investments to traditional financial instruments. What is important, as an addition to what Maria mentioned, is that in such structures, the reliance of the investors is on the investment manager, who they typically they know personally. They do not, investors typically require a lot of oversight, expensive oversight by the regulator, by the banks, custodian banks, and by the Big Four. They typically rely on the expertise. We also quite often see that the managing partners of the general partner are also putting their money, so they have skin in the game. So that provides a lot of kind of assurance to the investors that the structures will actually execute the strategies that they agreed, and that leads to a significantly lower cost while providing the comfort to the investors that they require. The regime, kind of quite light regime of the licensing can be kept by such funds in any way up to one, if the funds under management are below 100 million euro, which is quite a sizable amount. But if the fund does not use leverage at the fund level, that can be kept up to 500 million, which is even bigger. These funds obviously have a certain amount of restrictions. Number one, investors who can they address. These are typically qualified investors, ultra high net worth individuals, the activities that they can do. So there cannot be any wide spread distribution, for sure no promotion or marketing of those funds. But as we discussed, for the managers from the former Soviet Union, that is typically okay. They know themselves, the investors, they have previously quite likely worked with them, and they're quite confident to reach the investor base just through the contact book. The unregulated status, as we call it, does not mean that the fund is completely out of the picture and is not on the radars of the regulator. Not at all. The management company is AFM, which is registered with CSSF, provides annual reporting to the regulator, provides quite detailed, in fact, reporting, but is not under onerous obligations and supervision, of all the transactions, does not require an annual audit from the Big Four, etc., etc. So there was a question which we received prior to the seminar, whether it is possible for an investor not to be identified or not to be known to anyone. No, the answer is no. Number one, obviously the money have to be deposited one way or another. So the transaction must go through the banks. And as many people know, banking transactions now is quite a difficult affair. Opening bank accounts is difficult. Making transactions is difficult. Passing the KYC is even more difficult. So obviously this needs to be disclosed to the banks. But secondly, as I mentioned, the funds, even though they are called unregulated, it doesn't mean that the regulator does not see them or does not require and does not receive the full information about the investors, the investment activities. In our VC fund, we actually report on the no conflict in the portfolio companies. We invest in IT startups in all across the world, in the UK, in the Southeast Asia. There are a few investments in the former Soviet Union, but the regulator requires even a detailed report on the absence of the conflict check at the portfolio companies level. Therefore, information such as is it possible for an investor to invest through a partnership and not to be known to anyone is in those circumstances is a little bit of a nonsense. No, the answer is it is not possible. Here you have a very simple chart, or simplified chart of the capital pooling. This is what we've discussed earlier, kind of light club deal style structure, where you see typically an originator this is typically a customer of client who comes with an idea that he or she would like to set up a fund in Luxembourg. The choice is in Europe, at least, not very large. Luxembourg indeed is very much known as a fund center, and it provides a huge array of different types of structures. Therefore, the choice is sometimes already made. So the customer approaches Ziffer with an idea to set up a fund. Then the discussion is about who would be setting up the general partner, the need for more difficult or quite general limited partnership agreement. But in essence, there's this already existing pool of investors who are typically prepared to invest with originator through the structure into investment strategy which the originator has already presented. So that's a very typical approach of what is happening lately, I would say in the last probably couple of years. What is also quite common is that investors are choosing former managers who used to manage their portfolios in the past. And we, from time to time, see funds that are not dedicated to a single investment strategy. So if you see in the previous chart, these are typically single investment strategy funds, or kind of small, like family or a small club deal structures where the capital is spread. In the other example, the second example, you see that this is typically a person who handles ultra high net worth individuals, and then he sets up different investment classes, or he proposes different investment classes, and then he segregates the investments. In this particular case, an investor A may have a choice to invest into, for example, commercial real estate, venture capital, and digital assets. And he or she may have an option to invest into, this building, pass the next building, invest into a third deal, invest into this or the other deal on the venture capital. The structure of the vehicle, of the fund, allows it with the use of the tracking shares. So for each particular investment, the fund, typically it is legal personality structure called SCS, issues shares which track a particular investment, and then a pool of investors, let's say 50, can agree to participate in this deal or to skip it. This is also quite a common request from the investment managers coming from the former Soviet Union to manage assets of a group of investors that is known to the originator, but who do not want to commit the capital and who would like to decide on a more or less deal-by-deal basis participation in this or that investment opportunity. At the same time, running our investment fund, we saw that there are often requests for co-investment opportunities, i.e. an investment manager has identified a certain investment, has performed the due diligence, is quite happy to proceed with an investment, but then there is a number of financial co-investors who would like to tag along. Whether the investment manager charges a carry or a success fee or not can of course be discussed, but in essence, for successful investment managers, typically there are one or two, sometimes more, financial co-investors who are happy to tag along to their deals. Therefore, we created a platform called VNX, which is located in Luxembourg, which allows to structure such co-investments. The top of the picture you see, it's pretty much the same. So you see the client who is originator who sets up the general partnership, the fund, who has initial investors, but then for each investment, the fund creates an investment SPV, which then will invest into investment or portfolio company or any particular investment project. And then through VNX platform, they raise co-investment amounts from financial investors. We've already executed at least 2 transactions using this platform. The platform is based on the blockchain technology. So co-investors receive digital assets that represent either shares or cash flow from the investment project. But we believe that such co-investments can also be using VNX platform or not necessarily using VNX platform, can be executed by the funds in Luxembourg using investment SPVs. And we also see that demand for such co-investment club deals may not necessarily be at the fund level. It can also be on the particular investment level, and there are possibilities to structure it. What is also important to mention is that Luxembourg is focusing very much on the development of the financial center. It has already become the biggest financial center in the European Union, but the government is also focused to diversify the economy from pure financial services, therefore really tries to develop fintech, so financial technology startups which are focused on cybersecurity, artificial intelligence, and blockchain. Luxembourg is one of a very few jurisdictions where there are 2 regulated cryptocurrency exchanges, which already passed law allowing securities to be issued on the blockchain. And therefore, we see that there is a mixture between the pure financial players, so the companies who help to set up funds, manage funds, accounting companies, legal companies. There's a mixture of the managers who manage the money, but also financial fintech startups who are coming and providing the new ways to either secure the investments, such as cybersecurity companies, to have better analytics or automation of the investment process, such as in artificial intelligence, or the new way to record and execute transactions, such as in the blockchain. And VNX is one of the very few working blockchain-based investment platforms in Europe, which actually executes deals. So there's another aspect to Luxembourg, which is not known, but that can actually be quite attractive to the entrepreneurs from the former Soviet Union. That's it from our side.
Okay, thank you, Aleksandr. Thank you, Maria. Maria and Aleksandr have been so efficient, and they have worked in such an harmony that I did not get a chance to actually introduce Aleksandr properly. I would like to share my screen, if I may. While at the moment I understand that Maria is sharing hers, and simply to say that Aleksandr is an MBA, holds an MBA from Columbia University and a degree from London Business School, and he has an extensive experience in marketing, sales, and business development of large multinationals, and this is why he apparently forms a perfect complementary part to Maria's business. Now, I have very good news to share with you, Maria and Aleksandr. Our participants have got so much interest in your presentation that they are getting straight to the point. They're asking how much. What are the annual costs, and what is the setup cost for such an investment fund? I've got questions asked simultaneously from 2 interested participants.
It's very difficult to answer very specifically, because the funds can have a totally varying number of operations that would lead to what transactions. It could be a very active venture capital fund executing, for example, 2 deals per month. And obviously a lot of reporting, a lot of transactions, etc., etc. Or it could be a very simple club style, club deal style structure, which executes one transaction per year. But on average, I would say, as a rule of thumb, the setup and support of the unregulated investment fund can be in the between 45,000–50,000 euro per year to probably 80,000 euro per year, and a regulated entity may be 150 to 200,000 or more. That is actually just very preliminary figures without too much kind of detailed, etc., etc. But it should give the audience of a price range where they could kind of pinpoint one to another.
Okay, Aleksandr, one more question concerns reporting. Mm-hmm. Does the fund prepare reports on each investor, his income in particular? And if so, where do these reports end up?
The report on the income of each investor is not requested or is not required. Obviously, there is a general level of the KYC that the investors need to provide, as well as AML. So it is necessary, and Ziffer can help the fund managers to collect and to perform KYC AML checks. But the details of the income of each investor are not collected and are not reported.
Mm-hmm. Thank you. In case of any problems with the fund, and here I understand the question is very general, but mm-hmm. Okay, let's assume some kind of management problem or business issue. How is the investor holder of the investment unit in the fund protected within such a fund?
What we typically see as a protection measure of the investors is that a prohibition of the fund to use leverage, meaning that the fund, of course, there may be a lot of problems with the fund and a lot of issues with the fund, but one of the kind of typical protection measure is to protect from borrowing and then thus not being able to repay the borrowed amounts. On a more general level, the unregulated funds do not provide protection that, for example, the regulated funds claim to provide. When I say claim to provide, in Luxembourg law, the kind of private cells of regulated funds can be segregated. However, it also is necessary to note that in some jurisdictions, for example, the US, etc., it's as far as I know, a known concept that within one legal entity you may have, fully protected cells. Therefore, you still need to understand that although you're fully covered and protected in a regulated structure, within Luxembourg, it may not necessarily be the case in the other countries. So there are certain measures of the protection. Typically, investors include them in the LPA to protect their interests. There is a certain difference between the protection of the investors in regulated and unregulated funds, but it also depends on the jurisdiction of the claims, litigation, as well as other legal aspects of the proceedings.
Okay, there's a question about restrictions for trading instruments. Are there any?
Unregulated vehicles can actually have very little restrictions. For the regulated, yes, there is a necessity. For example, if you take a very typical SIF, specialized investment fund, there is a necessity to diversify the investments. In many cases, there is a limit of what the fund can invest into a particular asset class, no more than 30%, for example, things like this. Therefore, unregulated funds provide a much broader scope of investment instruments where the fund can invest, while the regulated are much more kind of limited. For example, the local regulator called CSSF some time ago issued notification that regulated funds cannot invest into cryptocurrencies. Unregulated can. So this type of very simple representation of the limitations. Unregulated funds are much less limited into what they can invest.
Okay, there is one very technical question. Please advise, what are the guarantees of the safety of assets for an investor when registering his sub-fund in an already registered AIF or RAIF?
It's a very interesting question. We're not specialists on the RAIF. RAIF is a licensed entity. I think it would be necessary to see that more specifically with the fund, with the documents of the fund, to see how it's structured. There are a lot of details on how the fund is structured, what are the legal documents, etc., etc. Therefore, here there is no generalized answer.
Are you in a position to comment on the type of statutory documents that the investor will receive when opening a sub-fund?
Sub-fund, in a sense of unregulated entity, is not necessarily a sub-fund per se. What we said, the diversification consists of the tracking shares. So it's a different class of shares. Therefore, what happens is that the investor signs a subscription agreement to a particular class of shares, and then he receives a full set of documents showing the registry, shareholders registry, or extract from the shareholders showing that he or she holds a particular number of the shares in a particular subclass. Typically, when we deal, for example, in our fund, we're able to provide the full set of documents starting from the investor to the portfolio company, including the documents that the fund has actually executed a particular investment, and the full set of documents that support the investment transaction, etc., etc., etc. So normally it shouldn't be a problem to receive quite detailed set of documents related to the investment of the fund, both at the fund level, meaning that it's a transaction between fund and the investor, as well as the fund with a portfolio company or an investment.
Okay, thank you. The questions are coming in, and here's another one. Are there any risk management filings?
Depending on the type of the products that the fund invests, there may be a need of the risk manager, but in our particular case, for example, in a VC, there is no need for the risk management. Therefore, there is no need for the risk management filing.
Okay. What about trade in OTC illiquid products?
For the unregulated funds, that's possible.
Mm-hmm. Okay, and another question concerning liquidity, but in another sense. If the fund has become illiquid for various reasons, it cannot continue to operate, can the investor, in this case, apply for compensation to the Luxembourg state authorities?
I'm not 100% sure that it is, well, number one, unregulated funds by its nature, even regulated funds, if they're not listed, they are by their nature illiquid, i.e. They're not listed on any exchange, therefore an investor cannot simply go and sell their share in a fund. So investments in regulated or unregulated funds, unless they're listed on an exchange, are illiquid inherently. Also, what is necessary to note is that the Luxembourg state or the Luxembourg regulator would really, of course, would deal with all the problems or would look into the issues that that arise at the fund level. However, for the authorities to act, there needs to be a serious breach of fraud, misconduct, etc., etc. And normally it is dealt or established in the courts. What the question implies, or as a kind of sub-question, whether a fund manager can do a distribution in kind, i.e. he or she invested into a particular instrument, he or she cannot turn it into money to distribute to the investors, whether the distribution in kind is possible. Normally it is possible if it's not against the limited partnership agreement, and normally this provision is written in the limited partnership agreement. Yes, in that particular case, if the if the general partner cannot sell the asset to distribute cash, normally he or she has a right to distribute the underlying asset to the investors, and for that you don't need to have intervention of the regulator or the government authorities.
Okay, I am afraid we are running out of time, at least when we're talking about the time which the organizers have reserved for us. So here is the last question that has just come in concerning an Islamic/ethical fund. Mm-hmm. Are you aware of any fund, that's my understanding, that plays by the rules of either the Islam or, generally speaking, another code of ethics? And if yes, what has been its performance? That's the question.
Some time ago, Luxembourg was, there are possibilities to set up Sharia compliant funds. I'm not aware about the setting up or success of many of them. I know that there were quite a few announcements. We have never dealt, or we have never operated one, although the legal framework allows for the setup of, for example, Sharia compliant funds, but whether they are successful or not is very difficult to say. I haven't seen a lot. We for sure have not dealt with one, and it's very difficult for us to say, how they've performed.
Okay, Aleksandr, that is all very useful. I understand there would be even more questions, and therefore I would invite everyone to continue to write their questions either to Bosco or directly to Ziffer, and then perhaps you can get back with some more explanations at the end of this workshop during the Q&A. So I thank Maria and Aleksandr for their input. and I invite all the participants to think about what possible questions they might want to ask. And at the end, we're going to have a Q&A, so that will be the time when they will be able to answer some more questions.
Absolutely. Thank you very much, Adam.